Hey guys, it's Mr. Oxy coming at you live from Palm Beach in Florida. Yeah, for tonight I'm going to be Mr. Oxy again. It is Wednesday evening, it is May the 10th, and we are going to talk a little bit about Oxy because obviously they just reported their Q1 results. Now, the results were, okay, but they were not that great. They came in with earnings per share of $1.09. The analysts were expecting $1.30. So, you can say the analysts were over anticipating the performance for the quarter. Otherwise, you can say Oxy underperformed, whichever suits you better. Anyway, from a revenue point of view, they came in at 7.2, almost $7.3 billion, which was about 3.7% below expectations. Now, the interesting thing that's of note here is that the year-to-date performance of Oxy is about negative 7%, while the S&P 500 is about positive 7%. So if you are an Oxy long investor, like I am, it's still one of my largest positions, then year-to-date, we are down, or I am down 7%, whilst almost everything around me, excluding perhaps Silicon Valley Bank and First Republic Bank, and a few other stocks, including energy stocks, are down. So energy is down overall, but Oxy is down 7%, and the S&P 500 is up 7%. Interesting turnaround and interesting swing there if you're an energy investor, which I am. Let's take a look at Oxy. So they reported there's not a lot of mind-blowing stuff here. It's arguably not great, but at the same time, it's not bad. So $1.7 billion in free cash flow is pretty good. We have seen a few quarters in the last year, 2022, when Oxy blew right by $3 billion a quarter. So 1.7 is a little lower, but we need to take into consideration that the commodity price has been tanking, and WTI obviously is sort of hovering around the $70 mark. They repurchased 750 million shares. They have paid back or started paying back some of the prefers with a $650 million redemption triggered. The oil and gas production, so on a million barrels of oil equivalent per day basis, it's pretty much flat. It's same as usual. OxyChem is always a good performer for them. Moody's investment grade rating, positive outlook. So a little bit of good news on that front. Generally, having the investment grade restored means two things. Firstly, you get better access to capital markets should you require money. And secondly, obviously, you can also secure a lower interest rate. So 2023 cash flow priorities. By the way, these are their slides. It's the fancy marketing slides. My financial slides will come up a little later, and I'm also going to talk a little bit about tax harvesting for those who are not familiar with it in terms of what we can do. Specifically on that topic, I'm going to talk a little bit about the hit that I took on ICANN because I exited the position, and I offset that somewhat by selling some of my Oxy because I didn't want to take the full hit of the tax loss because I don't need it at this moment in time, and couldn't carry it forward anyway from a personal tax point of view. Ongoing focus, sustainable and growing dividend. We're going to talk a little bit more about the dividend when I get into the financial slides. We know they've been repurchasing shares. They previously last year announced that they were going to buy back about $3 billion worth of shares. They started redeeming the preferred equity, as I just mentioned. And then the future priorities are debt reduction and cash flow growth. Nothing here sort of jumps at you. It's pretty much, I don't want to say same old, other than for the preferred equity redemption. It's pretty much the same stuff we've seen before. Enterprise value. So when Occidental talks about EVs, they're not talking about electric vehicles, which, by the way, there's no such thing as an electric vehicle. There's a rechargeable battery vehicle. But if a vehicle is actually electric, it would probably need to have a cord to plug into some power outlet, and then you have to drive around with a cord attached to your electric vehicle. They should call them battery-operated vehicles or battery-powered vehicles instead. But here's a nice switch, right? So I talk about by the way, that was just a joke. Don't come at me with your EV stories, okay? So I just want to talk a little bit about enterprise value here. So I've talked in previous videos, if you've been with me for a while, about the balance sheet quite a bit. And in its most simple form, you effectively have on one side of the ledger, you have assets, and on the other side of the ledger, you have liabilities and owner's equity. Now, arguably, obviously, owner's equity is a liability because the business owes the owner's equity to the owners. That's why it's on the liability side. So in real terms, the balance sheet is basically just assets equal liabilities. And the liabilities are split between owner's equity and or shareholder interest, if you prefer, and liabilities, which is debt. So if we look at what Oxy is doing here, it's actually an interesting switch, right? So we look at September 30th, 2020. Now, obviously, they picked this specifically because it looks really, really good when you display it graphically, because the timeline here doesn't necessarily make any sense because they're comparing September 30th, the end of the third quarter 2020, to March 31st, which is the end of the first quarter 2023. So we're looking at a period of approximately 18 months. But the reason why they chose this graphic, I'm sure, is because of this number here, 67%. And the legend is down here at the bottom of the screen. So on September 30th, 2020, the net debt was 67%. And on March 31st, 2023, the common equity value was 67%. So I'm pretty sure they specifically selected these pie charts because 67 equals 67, which means on the balance sheet, you have assets, and on the other side of the ledger, the long-term liabilities have basically flipped over into owner's equity. One of the benefits for us as Occidental long investors has been Berkshire Hathaway's purchases, which has helped to keep the stock price in a sort of generally upward trend, except of late. And as I just mentioned, they regained Moody's investment grade rating, which is good news for everybody, especially Oxy. Here's the preferred equity redemption. I'm not going to spend too much time on these slides because you can download them from Occidental's website and go to the investor link. And then you can download these slides for yourself if you want to spend a little bit of extra time looking at the slides. But you can kind of get an idea here as to why it was triggered, because they had an agreement at the time of Berkshire Hathaway's funding, $10 billion in terms of preferred shares for the Anadarko acquisition, or merger if you prefer. They had an agreement that the return of capital to shareholders, so to common stockholders, would trigger the redemption of preferred equity. And that is why we are in this particular situation right now. So at the bottom, right at the bottom here on the left-hand side, you can actually see the trailing 12-month shareholder distributions. And then you can also see sort of the scope of the dividends that they've been paying out to common stock investors. I mentioned the $1.09 earnings per share. Arguably, it was a little bit of a disappointment. You know, on the back of the envelope math, I would have expected about $1.30. And from a revenue point of view, I would have been okay with $7.5 billion. So if I were the analyst, I would have gotten it wrong as well. So can't be too hard on the analyst because I'm in the same category that they are. Unrestricted cash balance, $1.2 billion. I'm going to come back to that in just a minute because I want to show you some liquidity ratios on Occidental, which do not look too good. And then right at the bottom here is a little note. Q1 2023 earnings were impacted by a sequential decrease in domestic oil realizations as a percentage of WTI compared to the fourth quarter of 2022. Incremental impacts to realizations included third-party maintenance and outages along the Gulf Coast, $3.50, and in the DJ Basin, $1, right? So there were some negative events that were impacting or that had impacted their performance in the first quarter. And hopefully we will not see a repeat of that in the second quarter. And I say hopefully because we includes me, because I am still long Occidental Petroleum, right? Shareholder return framework. So once again, there's good stuff here, but it's not necessarily news. Sustainable and growing dividend. They just increased the quarterly dividend to 18 cents per share. I'm going to talk more about that one in just a second. Dividend sustainable at $40 WTI. Most people, I talked about Devon Energy yesterday. They're also modeling at $40 WTI just to be safe. Share repurchases, obviously, they approved $3 billion of share repurchases and completed it in 2022 and refreshed another $3 billion of share repurchases authorization, which is now 25% complete as at the end of Q1 2023. Enterprise value rebalancing, we talked about that as it relates to the balance sheet. So let's go into the financials here for a few minutes, then I'm going to talk about some tax loss harvesting for those who are not familiar with it, and then I'll wrap it up. So you can buy Occidental Petroleum for $57. I would not be a buyer of Occidental for $57. For around $50, I'd rather buy Devon Energy than Occidental Petroleum, but that's just where I am right now. As a result of the relatively poor performance for Q1 2023, Oxy took a little bit of a nosedive today. But in addition to that, of course, the EEIA also announced that there had been a surprise uptick in inventory in the United States. Most of these numbers are just like smoke and mirrors in terms of inventory and stuff like that. You cannot rely on the government's data at all. I'd be more inclined to say that the large oil companies like Goldman Sachs and Morgan Stanley, who are the primary traders of commodities, are more likely to be the culprits that are pushing energy up or down, depending on which day of the week you look at the ticker symbols. You can see Oxy sitting over here to the left side of the 52-week range is now super cheap. It actually is super cheap if you use the PE ratio as a benchmark because it's less than 5. So it is really inexpensive. As I said in the video that I launched just yesterday on Devon Energy, I'd rather buy Devon than Oxy. And one of the reasons why is for the dividend, right? So on an annual dividend yield basis right now, Devon's paying about $50, $5 on a $50 share, which is almost 10%. Oxy, on the other hand, is paying 72 cents. Now, 72 cents is of interest to me because my stock basis right now, because I actually sold some of my expensive, relatively speaking, Occidental stock in order to help cover my losses on ICANN. And because I sold my expensive stock, my cost basis adjusted lower. So now my cost basis is about $10 per share on the few thousand shares that I hold in Occidental Petroleum. And when your cost basis is $10 and your dividend is 72 cents on an annualized basis, my dividend yield is actually 7%. So the 72 cents that you see here expressed as a percentage is a percentage of the current price of the stock. So 72 cents is 1.22% of 57 cents. But as I said, my cost basis is about $10. So 72 cents is almost 7%, which is the primary reason why I would keep Oxy long in my portfolio. The other reason why I would keep it long in my portfolio is because if I just exited the entire position, I would have a massive tax liability. And I don't feel like paying so much tax right now. So I'll just keep Occidental, collect the 7% dividend as it relates to my particular holdings, and just quietly watch Oxy do whatever Oxy does. It's fair to say over the last 3 years, Oxy has been a phenomenal performer despite the pullback. So if you look at the chart here on the right-hand side, you can see it's easily outperformed the indices. But at the bottom, right at the bottom of the screen here in the middle, you can see that the short interest has actually crept up alongside the institutional holdings, which are now at about 80%. Let's take a quick look at the valuations, and then I'll get into the tax harvesting. So Oxy seems fairly valued on a valuation basis with a PE value of 4.75. I just mentioned that. The industry average right now is around 6. That means the entire oil and gas and consumable fuels industry is super cheap because the PE is only 6. The average PE on the S&P 500 hovering currently around 14, which means the entire energy sector, as we can loosely refer to it, is super cheap based on the PE ratio. And remember, sometimes the ratio might look good for all the wrong reasons, right? So always do your due diligence and make sure you know exactly what's going on in the stocks that you make investments in. And hopefully you don't get surprises like we had with ICANN Enterprise Partners. Price to book ratio for the most recent quarter, 2.6 versus the industry 6.49. So Oxy looks fairly valued, which is another reason why I would typically just hold it. I wouldn't buy Oxy at 57. I know there are a couple of guys on the channel. Mike is one of them who said if Oxy gets back down to sort of closer to 50, he'll buy some more. I think 50 would be a good entry point for Occidental. 57, maybe, obviously sort of 10, 15% higher. A little bit too rich to open a new position despite the low PE. Not because Oxy is bad necessarily, but because there are better energy buys in the market right now. than Oxy specifically if you wanted to buy, right? If you want to hold, you're fine. If you want to sell, you could probably take some profit. Profitability, Oxy is doing a pretty good job. So gross profit margin on a trailing 12-month basis, so TTM, trailing 12 months, 67% versus the industry's 41. Operating profit, 37 versus 21. And net profit, pretty good, 36 compared to 16. So from a profitability point of view, Oxy looks pretty good. The dividend, of course, is relatively speaking quite weak because even though from a personal point of view, 72 cents yields based on my cost basis about 7%, for the majority of people, it's yielding more like 1 or 2% because your cost basis might be sort of in the 50, 60 range. If you're a newcomer to Oxy and you've just recently opened a position in Occidental Petroleum. So this benefits me, and this is one of the reasons why I'll hold it long. I'll just keep the dividend, and I'll reinvest the dividend as it pays out and buy more Occidental shares at whatever the price is at that point in time. So this chart is pretty much meaningless because obviously Oxy had cut the dividend to 1 penny, which basically is almost like zero, except you don't want to make it zero. So if you hold it at 1 penny, you can always change it anytime you want in the future. And right at the bottom, the dividend growth rate over the last 3 years has been terrible. But the dividend change in the middle of the screen looks pretty good because if you start with 1 penny, pretty much any change you make, if you move from 1 penny to 2 pennies, you're up 100%. So that's a little bit deceptive, right? Growth rate analysis, if we look at the valuation here, Oxy is actually lagging and not doing that great on a quarterly basis. Earnings per share growth for the most recent quarter is negative 30%, while the industry has actually been up 168%, regardless of the low prices on WTI and Brent. On a 12-month basis, trailing 12 months, Oxy looks okay, but that's because it came off the highs of that were achieved last year, and now it's taken a sudden dip. Revenue for the most recent quarter, also not a good picture at all, negative 12% compared to the industry's positive 11%. But on a trailing 12-month basis, it's still sort of okay, although it's starting to lag. I don't expect Oxy to do any great things. For instance, in Q2, it's kind of steady Eddie. It's no longer a growth stock for me. I wouldn't even call it a foundational stock. The only reason why, or reasons why I would keep it, are the two that I mentioned. My dividend is currently yielding approximately 7%, and at the same time, I'm sitting on a large gain. So if I sold the gain, I'd have to pay tax. More about tax harvesting in just a second. Almost done here. Financial strength. Now, here we have a problem. This is not good. Oxy, even though it's paid down a lot of debt, still has a debt-to-capital ratio of almost 40%. The industry is at 30%. So Oxy is almost 30% above the industry average here. So this is not a good picture, despite the fact that Oxy's debt has come down quite a lot. Now, of course, as they pay off the prefers and start redeeming them, that's going to drop even further because the prefers are part of the long-term debt. Now, but here's the problem, right? So there are not enough liquid assets to satisfy current liabilities. It says at the top of the page. Why does it make this statement? It's over here. So if you look at the quick ratio is how much cash do you have in the bank and how much bills do you have to pay at the end of the month. So think of it from a household point of view, and let's just make a really simple example. Let's say your house and your car and your food is $1,000, and you have $800 in the bank. You have a problem, right? So if you this month have to pay $1,000 for your house, your car, and food, and you only have $800 in bank, you have a problem. So you can either borrow, or otherwise you can see if you can sell something like Oxy. It's also selling stuff every day, right? It's generating 1 million barrels of oil equivalent per day or more. It's got to sell the stuff, right? It can't sit on the inventory. The inventory cannot pay the bills. The quick ratio specifically compares liquid cash, not cash and cash equivalents, because sometimes the cash equivalents includes a facility that's undrawn, which is debt, right? So right now, Oxy just does not have enough money in the bank to pay its immediate short-term liabilities. That's the quick ratio. The current ratio is cash and cash equivalents compared to current liabilities. The industry is above 1, which is fine. You need to be at 1 or above. Oxy is flying too close to the sun here at below 9. This is just not good enough. And in addition to that, the operating earnings are unable to service the debt. So Oxy, from a management point of view, need to kind of figure out how they want to do this year. They, a little bit of a bind from the point of view that they're starting to redeem the preferreds. That in itself is eating into the cash flow. But, these are things that they have to address, because you cannot have a balance sheet where you simply do not have enough cash to pay your bills on a short-term basis. You have to pay those bills. So they got some work to do in that regard. For the people who regularly follow the channel, you'll recognize the screen from TipRanks. TipRanks has a number of analysts here giving us some coverage. In fact, you have 17 analysts. The one sell analyst is Equilor, I think it is. 9 analysts say buy, 7 say hold. I'm in the hold camp. I wouldn't buy it here. It's a moderate buy according to TipRanks, with an average price of $71. The majority of the analysts have either reiterated their previous estimate or otherwise maintained it. There haven't really been any up or downgrades per se. And as I said, only one person is saying sell. Now, let's talk a little bit quickly about tax loss harvesting, and then I'm going to wrap it up here. Now, tax loss harvesting varies from jurisdiction to jurisdiction. And the reason why I say that is because, for instance, in the United States, as a US tax person, I can only deduct $3,000 of my losses against my income every year. So if I had to take a loss of $100,000, then I'm going to have to carry forward the bulk of it, because I can only deduct $3,000. In fact, it's even worse than that if you're single, because then you can only deduct $1,500 in the United States. So for me, married filing jointly, which is how we file our taxes, I can deduct $3,000 of my losses against my income every year. Now, I don't like taking losses at all, because like Warren Buffett, I believe in rule number 1, which is never lose money. And rule number 2 is never forget rule number 1. But every now and then, something like ICANN Enterprise Partners pops up. And at that point in time, I decide the fundamentals of the investment have changed so significantly, with so much new risk introduced into the equation, that I would rather just exit the position entirely. Take my lumps, take the body blows, feel the hurt, and just get out of the position entirely. Now, as I said, if you do have more than $3,000 in losses, you can claim the additional losses in the future. This is how it works in the United States. Obviously, from jurisdiction to jurisdiction, it might be slightly different. So this slide looks a little bit busy, but I'm going to kind of give you an idea of what's going on here very, very quickly. So right at the top of the page, you have some positions that are holding Occidental Petroleum, and the green arrow here highlights one particular line item entry, which is September the 3rd, 2020, when I bought 638.893 shares. I'm not quite sure why I would have bought such an extraordinarily weird amount, probably because I matched it to the dollar, for $12.65 per share. Nice price, huh? In 2020, in September, you could buy Oxy for $12, but how about this one at the bottom here? In 2020, in October, I could buy some for like $8.90, and boy, I did. I bought another 1,100 there. But specifically this line item here, I'm using as an example, right? So 638 shares, which I purchased for $12.65. And then I have this example here. They don't fit together. So this top grid here, these few lines is Occidental, and then these two sort of pinkish lines over here in the middle is ICANN. So on ICANN, in this particular account that I'm showing you here, I wanted to sell and exit the position 2,500 shares in one of my accounts. And these 2,516 units, because they're not shares, they are units, because it's a master limited partnership, would have triggered a net loss of $38,469, which is obviously quite a chunk of money, especially considering that I can only write off $3,000. So I figured, you know what, I may as well do a little bit of rebalancing, or you can call it tax harvesting if you'd like. So what I did was I sold some, not all, of my most expensive Occidental shares. And I'm using this as an example here. So 638 at $12.65. So if you look on the far right over here, Oxy is currently trading at $57. If I sold, I didn't, but if I sold 638 shares at $57, I would have raised $36,366 cash, which would be cash awaiting investments. Those shares, the 638 shares, based on my cost basis of $12.66, cost me $8,000. So if you take the $36,000 realized gain and you deduct my cost basis, which is $8,000, I'm left with a realized gain of $28,000 on Occidental Petroleum. So if I triggered this sale, I would make this realized gain, which is taxable, right? So now what I do at the same time is I book this loss and I sell the ICANN Enterprise unit partner units and capture a realized loss of $38,000. And I offset that realized loss against my realized gain of $28,000. And now I'm only down $10,000, which means what I can do now is at the end of this year, if this were my only transaction, I could effectively claim a $3,000 deduction against my taxable income for 2023. And then I would still have another $7,000 left over, which I can carry forward into the next year or the year thereafter, should I wish to book an additional loss or take some extra deductions against my earnings for that following year. The other option that you have when you're faced with a situation like this is not to forego the profitable position that you have with the unrealized gain in Occidental Petroleum and just do nothing. But then maybe you also would want to just hold on to your ICANN Enterprise Partner units and also just do nothing and hope that it recovers. For me, from a personal point of view, when the fundamentals of my investment changes significantly, I also change my investment thesis. So just by way of a more simple example, if ICANN, for example, were to have paid me a dividend of 15%, which they did, now based on their current stock price, it's more like 25% or something like that. But if ICANN paid me a 15% dividend and they cut the dividend in half, I might look at my ICANN position and say, where is it possible for me to achieve a greater dividend, assuming this is one of my foundational dividend stocks, which it was? Where can I raise the same or a similar type of dividend without the risk? So I want to mitigate the risk, but I still want to kind of earn sort of the same kind of yield, right? So there are ways that you can do that. I mentioned a couple of these equities in my previous video. One of them is Blackstone Minerals. Another one is Alliance Resource Limited Partnership. Alliance Resource is a coal company that pays about 14% in dividends. Blackstone Minerals pays about 12. Devon Energy is close to 10, right? So there are things that you can do. You're not stuck in any way whatsoever. But I did want to talk a little bit about tax loss harvesting because it's apt right now and it's current in terms of where we are right now. And then I just want to wrap it up with this one. So Warren Buffett announced just the day before yesterday that Berkshire Hathaway has no intention to take control of Occidental Petroleum. Now, that one is kind of a little bit mixed for me because I actually thought just a couple of months ago that Berkshire Hathaway was actually gunning to take over Occidental Petroleum. And I thought this could be quite a sweet deal, you know, because they might offer a premium on the acquisition and maybe buy us out at about $75 a share or something like that. And they might do a combination of cash and stock where maybe you get half your money in cash and the other half your money in Berkshire Hathaway stock. I would have taken that deal if it were up to me, but now it isn't. And Warren Buffett says he's not really interested in buying Occidental Petroleum. I hope he doesn't sell, you know, like if he exits, obviously that can impact the price negatively. So for now, you know, I'm just holding, but I actually honestly thought just a few months ago that Warren Buffett is slowly but surely moving into a position to take Occidental Petroleum lock, stock, and barrel. There is another sort of counter theory to that particular point, and that is that one of Berkshire Hathaway's largest position is Chevron, and they might have some sort of discussions over dinner one night in a dark restaurant corner somewhere where Berkshire Hathaway says to Chevron, why don't you just buy Occidental Petroleum? And you get a 2-for-1, right? You get Occidental Petroleum and Anadarko for a price that is not dissimilar to what you might have paid for Anadarko just 3 years ago on its own. Anyway, who knows what's going to happen? Let me know in the comments what you think. And as usual, thanks for watching. I'll be back soon. Bye-bye.